John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello, this is John Ulzheimer. I am a consumer credit expert. I have over 30 years of experience in the credit industry. I've spent time at FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the 3 recognized credit bureaus in the United States. All right, so today we're going to talk about how credit scores are used to set the terms of your loans or credit card accounts. So when you make an application for credit, the lender with whom you're applying is going to do a risk assessment. And that risk assessment is going to be used to determine whether or not the lender wants to do business with you and under what terms. If your credit report and credit score indicates that you are a very low credit risk, then it is very, very likely that you're going to get a very competitive offer, and you're going to also have offers from more banks and more credit card issuers and more lenders. Low-risk consumers tend to be heavily targeted by lenders because they're generally going to pay their bills on time, which means that the lender is going to make money off of doing business with them, and they're not going to have to worry about chasing down the borrower for payment. So that's in the loan context. The loan terms are going to be set based on a combination of a couple things. Number one, your credit score. Number two, the value of the collateral that you're borrowing money against. And third is going to be your income. So consumers who have very, very good credit scores are going to get very, very competitive terms. So let's talk about from a credit card context. Interestingly, the average interest rate on a credit card, let me just ask you, what do you think the average interest rate on a credit card is? So without looking it up, if you want to pause the video, if you can think about it for a second, don't look it up, but let me know what you think the average interest rate on a credit card is. And I'm gonna spoiler alert, I'm gonna tell you what the answer is. As of today, the average interest rate on a credit card is around 17%. And that's a general use credit card, so like a Visa or a MasterCard or a Discover. The average interest rate on a retail store card, so one with a store logo on it, is into the 20%. And so you're probably wondering, well, I mean, surely that's for someone who's got bad credit, right? No, that's the average interest rate for credit cards, including good credit, people who have good credit and people who have bad credit. So you're probably wondering, well, why do credit cards have such a high average interest rate where auto loans are so low, mortgages are so low, student loan interest rates are so low? Why are credit cards different? Well, remember, when you're applying for a credit card, you're essentially asking the bank or credit card issuer to trust that you're going to pay them back. There's nothing for them to come repossess. There's no car to repossess. There's no home to foreclose upon. There's nothing to come get. So really, it's just a matter of trust. And that's where the score comes in. So FICO, Vantage Score, those are the 2 generally used credit scores in the United States credit system. The lender is essentially using they're looking at the story that credit score is telling about you as a borrower, and they're going to listen to it. So if the credit score indicates your elevated credit risk, then they're going to subsidize the risk of doing business with you by charging you a higher interest rate. That's called risk-based pricing. So it's like lending 101. It's a very common concept in lending. It's called risk-based pricing. If you've got a very, very good credit score that indicates very, very low credit risk, you're very likely to pay back your obligation on time, so that they don't have to subsidize their risk by charging you a high interest rate. They can give you a very, very competitive interest rate because they know you're going to pay them back. You're not a risky borrower. So that's how it's done in a credit card context, understanding that pretty much everybody who opens a credit card is going to pay a higher interest rate on that card than any other form of credit that they currently have. So that's bad news. The good news is that if you pay your credit card in full every month, then your interest rate becomes irrelevant because there's no balance to pay interest on. You're not carrying any form of a balance month over month. And so the APR of your credit cards really becomes immaterial and for entertainment purposes only. And that's a really good position to be in, by the way. You want to be in a position where the APRs on your credit cards are meaningless. I have no idea what the interest rates are in any of my credit cards. You know why? Because I never carry a balance, and so I don't care what my interest rates are. So hopefully that gives you kind of an idea of how loan terms are set based on credit reports and credit scores. If you have any other questions, please leave them in this comment section below, and I'll do my best to get to them. Thanks a lot for watching, and have a great rest of your day. We'll talk again soon.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.